Oil just did something that happens only once every 3 years. The price crossed below its 200-week moving average. You just heard me right, the 200-week. The single most reliable long-term support in the entire commodity space. While everyone is panicking about a supply glut, the real story is hiding in plain sight. Most traders are selling this breakdown, but there's a divergence forming that could trap the entire bear camp. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today, with risk-reward ratios up to 1 to 5. Here's what nobody is telling you about Brent crude oil. Let me be absolutely clear on where we stand. Brent crude is currently trading at 78.77. The bias is trending strongly bearish across every time frame. Weekly, daily, 5-hour, and 1-hour all show strong sell signals, but here's the catch. We are now entering the most oversold territory this asset has seen in 2 years. The RSI at 28.9, CCI at -193, Williams percent R at -95. These are extreme readings. Write this number down. If we break 77.00 today, the entire structure resets and we have a clear path to 75.05 and potentially 71.65. If we hold 77.00, we are looking at a violent mean reversion rally that could trap the herd short. Right now, the herd is overwhelmingly positioned for a breakdown. Hedge funds have been piling into short oil positions for 6 consecutive weeks. The net speculative position is now at its most bearish level since the COVID crash, and that's exactly when reversals happen. Let me walk you through the chart, from weekly down to the 60-minute. This is where the story gets interesting. Starting on the weekly time frame, this is your macro compass. The 200-week moving average is sitting right here at approximately 83.88. And here's the brutal truth. We've already broken it. The weekly close below this level is a major structural breakdown. This level now becomes resistance. The weekly trend is strong sell with an ADX reading of 47.5. That's a powerful trend, not a weak one. Now zoom to the daily. Look at this. The price action is a textbook cascade. The MA20 at 91.89, MA60 at 94.57, MA100 at 91.20, and MA200 at 83.88 are all stacked above price in perfect bearish alignment. We've had a golden cross in reverse. The daily MACD is showing -4.71 and the histogram is expanding lower. There is no bullish divergence at the daily level yet. But here's the detail most traders miss. Look at the 4-hour chart. The 4H trend is strong sell and the MACD is deeply negative. But I want you to pay attention to the momentum oscillator. RSI at 28.9 on the daily, but the 4H RSI is actually starting to curl up from extreme oversold levels. This is the beginning of a potential divergence. Now let's zoom into the 1-hour chart. The 1H trend is also strong sell, but we are seeing the first signs of selling exhaustion. Volume has been declining on the downside bars over the last 24 hours. That's a classic sign of a trend losing momentum. This is where we need to talk about support and resistance, the only levels that actually matter. Key support levels. 77.00 is your first line of defense. This is a psychological level and also the site of previous consolidation from March 2025. Below that, 75.05 represents the 78.6% Fibonacci retracement from the 2024 rally. And 71.65 is the measured move target from the weekly bear flag pattern. Key resistance levels. 82.00 is the first hurdle. This is the former support that may now act as resistance. 85.75 is the 50% retracement level that would indicate a true reversal. And 87.70 represents the pivot point from the breakdown. Here's what most traders miss. The pivot point at 80.40 is critical. This is the level that separates a dead cat bounce from a genuine reversal. If we can reclaim 80.40, the downside thesis is in serious trouble, and here's the cross-asset linkage you need to understand. Oil is not moving in isolation. Real yields are rising, the US dollar is strengthening, and China's economic data is deteriorating. Brent crude is trading tick for tick with the correlation between the dollar index and Chinese PMI. A stronger dollar and weaker China demand equals lower oil prices, It's that simple. Now let's connect the news to the price action. Yesterday's headlines are creating a perfect storm. First, oil rose 1% on doubts about the US-Iran nuclear deal. This was a headline spike that caught shorts off guard. But here's the catch. That rally was immediately faded. Why? Because the IEA simultaneously warned of a massive supply glut coming in 2026. The agency projects that global supply will exceed demand by over 1 million barrels per day by the third quarter. This is the narrative war. Supply constraints versus demand destruction. The geopolitical premium is shrinking rapidly. Every time there's a ceasefire rumor or deal talk, oil drops 2 to 3%. The market is pricing out risk premium faster than any supply shock can add it. But here's the fundamental driver most analysts are ignoring. The real story is China. The analysts' articles you're seeing titled, "Will Oil Return to Pre-War Levels?" It depends on China's economic growth, are missing the key point. China's oil demand growth has slowed from 1.2 million barrels per day to 400,000. That's a 70% deceleration. And with the stimulus expectations being constantly pushed back, there's no catalyst for a demand-driven rally. The 1 to 2 week directional lean is clear. We are biased to the downside towards 75.05. But the timing is everything. The single event that invalidates this thesis is a 4H close above 82.00. If that happens, we are back in the consolidation range and the bearish setup is dead. Second interaction trigger. Do you think Brent crude tests 75 before month end? Comment yes or no. I'm tracking consensus. Most people skip this section. That's exactly where the money is made. Keep watching. I'm going to give you 3 distinct strategies. 1 for the conservative trader, 1 for the active trader, and 1 for those who can handle serious volatility. Let's start with the safest play. Strategy 1, the sniper, conservative. This setup is for traders who want to enter with a trend but wait for absolute confirmation. The condition is simple. We need a 4H close below 77.00 with increasing volume. This is the breakdown confirmation that signals the bear flag target is in play. The entry is on the close below 77.00, not the spike. We want to see sellers step in and push through that level with conviction. Stop loss goes just above the pivot point at 80.40. This is your invalidation level. If we close back above 80.40, the breakdown is false and you need to be out. Target 1 is 75.05. This is the 78.6% Fibonacci retracement and the first logical profit-taking zone. Target 2 is 71.65, the measured move target of the weekly bear flag. Risk-reward ratio from 77.00 to 75.05 is 195 pips. Stop loss is 340 pips. That's approximately 1:0.6R on target 1. But target 2 gives you 535 pips for a 1:1.6R. Not massive, but this is the conservative setup. The invalidation condition is a 4H close above 80.40. If that happens, the trade is off. The sniper, conservative, entry, 77.00, 4H close below, stop loss, 80.40 take profit 1, 75.05 take profit 2, 71.65 risk, reward, 1:1.6R invalidation, void if 4H candle closes above 80.40. Strategy 2, the active trader, standard. This is the play I'll be looking at personally. It's a mean reversion trade that takes advantage of extreme oversold conditions with a clear risk-defined setup. The entry condition is a bullish reversal pattern, preferably a bullish engulfing or hammer candle on the 1H or 4H timeframe, at or above the 77.00 support zone. We want to see price reject 77.00 with conviction. The stop loss goes 25 pips below the swing low of the reversal pattern. This will typically be around 76.50 to 76.75, depending on the pattern. Target 1 is 80.40, the pivot point and the first major resistance. This gives approximately 240 pips at 1:1.2 at a target 2 is 82.00, the 200-week MA and the most important resistance level. This gives approximately 400 pips at 1:2 at once target 1 is hit. I trail the stop to break even and let the rest ride. This protects capital while giving the second target a chance. The invalidation condition is a break below 77.00 with a daily close under that level. If we close below 77, the mean reversion thesis is dead. The active trader, standard, entry, 77.50, bullish reversal pattern at support, stop loss, 76.50 take profit 1, 80.40 take profit 2, 82.00 risk, reward, 1:2 are invalidation. Void if daily close below 77.00. Type your Brent crude price range for tomorrow in the comments now. Let's see who's aligned with the technicals. Strategy 3, the aggressor, high risk. This is for the risk-tolerant traders who see breakdowns as opportunities to chase momentum. The entry is on a break of 77.00. Not a close, but a flush below. We want to enter on a 15-minute close below 76.80. Anticipating panic selling to the measured move target. Stop loss is extremely tight at 78.00. That's 120 pips of risk. You're risking 120 to make potentially 600. Target 1 is 75.05. This is approximately 175 pips, 1.5R on the first target. Target 2 is 71.65. This gives 515 pips from entry, a 4.3 a trade if target 1 is hit, move stop to break even. If the momentum is strong, you can move stop to 77.00 once price breaks below 76.00. The invalidation condition is a 1H close above 78.00. That would indicate the breakdown was a false break. Only for those who can lose small and manage risk aggressively. To the aggressor, high risk, entry, 76.80, 15M close below, stop loss, 78.00 take profit 1, 75.05 take profit 2, 71.65 risk, reward, 1:4.3 are invalidation. Void if 1H candle closes above 78.00. Never risk more than 1 to 2% per trade. No positions through high-impact news. Stops are non-negotiable. This is how you survive to trade the next big move. Oil is volatile. On a normal day, Brent can move 2%. In these conditions, 3 to 4% moves are common. Position size accordingly. Let me summarize everything you need to know for the next session. The single most critical level is 77.00. If we hold above it, expect a violent short covering rally toward 80.40. If we break below it, the downside to 75.05 and 71.65 is in play. Tomorrow's focus is the API crude inventories report. If we see a surprise build above 3 million barrels, the break below 77 could happen pre-market. If the number is bullish, a drawdown, we could see a reprieve. Here's the key insight I want you to walk away with. The oil market is pricing in the worst-case scenario: supply glut, Chinese slowdown, rate hikes. The bearish positioning is at extremes. That means any positive surprise, any geopolitical spark, could create a massive short squeeze. But until we see that catalyst, the path of least resistance is down. If you want the full breakdown on how the dollar strength is impacting all 8 assets, that video is live now. Tap the end screen, smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.